The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A turnaround Tuesday flips to a wobbly Wednesday. From Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Steele. I'm going to call it Wilted Wednesday.
Yeah, wobbly, wilted, walk
Whacked
back.
out, walk back.
We're going to be doing this for the next 2 hours.
Yes,
Stick
we
with
are.
us.
So this is the story. You have higher yields and you have a lower equity market. This was kind of the setup in terms of the bond market for most of the day, but the equity market was able to work its way higher. But then we had that pretty weak 10-year auction. We had record issuance on investment grade in terms of bonds, and that really continued to weigh on the overall bond market, and then equities couldn't hold up and then slowly reversed their decline. Is this a blip? Or is this a continuation, Romaine, of Monday and Friday?
That's the big question of the day. Sentiment has certainly shifted over the last few hours. Some folks still out there cautiously searching for bargains after that historic 3-day market sell-off. A sell-off that we should point out has widely been perceived as overdone, particularly if you look closer at macro conditions. At least that's the view of famed economist Nouriel Roubini, known as Dr. Doom for his warnings about the 2008 financial crisis. But he says folks today are actually too pessimistic about recession probabilities.
I don't think the data suggests that we're going to have a hard landing anytime soon. If anything, actually, there's some elements of strength in the economy.
And then you have economist Claudia Sahm, whose cause celeb recession indicator was triggered last week. She also says it's not time to panic yet. There is no recession now, though she says we're not headed in a good direction. Former New York Fed President Bill Dudley, though, says while Sahm might be right that the economy isn't in contraction now, he wouldn't base monetary policy on that assumption. He says the Fed needs to act and act fast. That's going to be a big story, a big theme for us here on the show today. Meanwhile, we're also going to focus on earnings. That's also driving price action today. A bit of disappointment out of Disney. Weakness in its parks business earlier this morning, though that was offset by blockbuster showings for Inside Out 2 and Deadpool, the 2 highest grossing films so far this year. After the bell, we do get Warner Brothers reporting. No slouch itself. Godzilla and Dune among the 5 biggest films of 2024 worldwide. But investors, of course, likely to look past that and toward the TV and streaming division, which is reeling from cost cuts and the loss of a major sports contract. Nevertheless, let's go back to the macro and how it's really affecting the market trade out there, particularly when it comes to large caps versus small.
We could just keep watching.
I know,
Deadpool.
this is like kind of distraction here.
I love this movie, by the way. Okay, let's just have this really basic chart, and I appreciate how basic it actually is. It's a 5-day JIP of the S&P, but I think it really highlights where we're at. And you can see here, this is Friday morning at the jobs number, gap down. Really weak day on Friday. Big gap down when it comes to Monday. Another weak day on Monday. Then we try to rally here on Tuesday. We try to rally a little bit with a little gap up today, but we just can't make it. And then now we are rolling over. And the question is, was this the start of a downtrend, or is this just a blip in the middle of an uptrend? And how we can define that in a regime that continues to see increased volatility, Romaine.
Yeah, here on a daily basis, an S&P that was in the green by more than 1%, now in the red by 3 to 4/10%. But it's really the sell-off in the mid-cap and small-cap space catching a lot of people's attention. The Russell 2000 down 1% as we kick you off to the close here on this Wednesday afternoon. Jill Carey Hall joining us right now, U.S. equity strategist over at Bank of America. And Jill, I do want to start off with small caps, or at least kind of the relative play between small and large. It's been, it felt like it was like 5-6 weeks where small caps are really showing that they can kind of punch the weight with the large cap names. That's faded over the last few days. Does that continue?
Well, thanks for having me. I think from here, what's going to matter is earnings. So our view has been that, one of the necessary conditions for the Russell 2000 rally was that we could see more confidence in inflation slowing and more confidence that the Fed will be able to cut rates. That happened a few weeks ago and was a big driver of the rally. But I think now the other thing we're looking for is confidence that fundamentals for small caps can improve. And I think a lot of investors are looking at the earnings story because back at the start of the year, analysts were expecting that by this earnings season, small cap profits would have recovered, would have been very positive, would have been outpacing large cap profits. And that hasn't happened. The numbers have just continued to be cut. And this earnings season, it's been relatively weak for small caps so far. We still have a lot more reporting to go, but we're seeing, much fewer beats, much weaker guidance than in large caps. And when we looked at corporate sentiment on earnings calls, we're seeing so far this record negative spread between small cap and large cap corporate sentiment. So I think until we can see the fundamental trends turn around, the small cap rally is likely to, we to pause from here. But if we can see the fundamental shift that gives us confidence in that very back end loaded earnings recovery, then the rally could pick up again.
It'll be interesting to see if that happens. I mean, we're already worked our way through about half of the Russell 2000 in terms of earnings reports here. So we'll see if that other half actually shows something different. I am curious about the correlations to the macro economy, to the economic conditions. That is, there was a lot of talk here about that if you do think we're in a recession or at least headed towards a slumping economy of some degree or another, that small caps have a higher correlation than some of those large cap names. Are you finding that holding?
Yeah, I mean, I think, we've looked at the correlations of small caps to macro data and to various indicators. The ISM manufacturing indicator is still one of the most correlated indicators with not only corporate profits overall, but with small versus large cap relative performance. So we've obviously seen several weak months in the ISM. Macro data, we do continue to expect a soft landing in the U.S., but, typically these, when we look at different macroeconomic regimes, we've been in a recovery regime since earlier this year. Last year we had some weakness. We had an earnings recession in the U.S. Small caps typically do well coming out of that and when profits recover. But now obviously we're watching a lot of the macro data, and if it were to start to weaken further, then in those macro downturns, that's typically a period where you want to own quality and larger caps.
Right. So Jill, if we sort of get through this soft patch, do we revert back to the rotation trade that we were all talking about 10 days ago in terms of sell tech, buy small caps?
I think broadly, we have expected a rotation in the market, particularly within the S&P 500 out of the Mag 7 and into the other 493. And that's where you are seeing those earnings trends start to shift. You've seen more sustainable evidence of that within large caps, that the earnings for the other 493 are picking up versus slowing for the Mag 7, which are also investing heavily in CapEx. And so that story is there for small caps as well, but it's just taking longer to play out, and we're not seeing as much evidence of it. So, I think if we do see soft landing, no recession, and if the small cap earnings data can improve, then that rotation may likely continue, especially if we're in an environment of Fed cuts, given all of the refinancing risk for the Russell. So near term, bottom line, we still think there's opportunity within pockets of small caps, particularly those that are higher quality, have been able to beat and raise, see upward estimate revisions. But for the Russell 2000 overall, we think it may be a challenging period. Volatility also typically picks up in this period, especially in election years. So owning quality and sticking with large caps for the near term may be more prudent.
Yeah, I was going to say, so I'm looking at the VIX, it's at 26, far cry from 60, but also a far cry from 12. If we're in a more consistent, higher volatility regime, that's U.S. tech large cap, yeah?
Large cap over small and really quality. I mean, when we look at what's been consistent when volatility picks up, just stocks that have stable rather than volatile earnings have been a very consistent outperformer in those environments where the VIX picks up. I think for large caps, we've been more cautious on tech relative to some of the other sectors. Mag 7 stocks have been relatively more expensive and over-owned by fund managers versus some of the other cyclical areas. I think even if we're in a slowing macro environment, we still expect a CapEx cycle in the U.S. We have a lot of aging and crumbling infrastructure. We have reshoring. So even though CapEx is something that's usually cyclical, there may be more of a case for a CapEx cycle this time around. So, we still think that a rotation is likely, but near term, if there are concerns around a slowdown, we think sticking with high quality stocks, it makes sense.
Jill, always great to talk to you. Jill Carey Hall, U.S. equity strategist over at Bank of America, kicking us off to the close here on this Wednesday afternoon. Coming up, U.S. mortgage rates falling the most in 2 years, and that's sparking a surge in refinancing applications. More on that move ahead of the earnings results out of Zillow.
All right, plus you got European gas prices hitting the highest level of the year on reports that Ukrainian troops seized a key pipeline near the border in Russia. The geopolitical risks coming back into the energy market. Rebecca Babin of CIBC Private Wealth will be joining us. And a closer look at the AI trade that was. Infrastructure AI stocks falling today, including shares of Supermicro down 20% as investors grow more cautious about weak profits. That's our stock of the hour. All that and more coming up in a bit. This is The Close on Bloomberg. right, European gas prices hitting a 2024 high today. This is after reports that Ukrainian troops seized key gas transit point near the border of Russia. Rebecca Babin, senior equity trader at CIBC Private Wealth. And this also comes on the heels of oil getting a nice little rally here despite getting hit quite hard in the last few weeks. Should we be pricing in geopolitical risk now in the energy market?
So the answer to that is no.
No, really? Why?
I think for a couple reasons. The first is the geopolitical risk premium that gets priced in is so quickly faded because unless you actually see barrels come off the market, there is not a lot of appetite to buy into that rally. And ultimately, what we're seeing happen in the Middle East and what we're seeing happen in Russia is some slight escalation, but I don't think that the market is anticipating or is going to start to see actual supply come off the market. We've had these head fakes, Alex, how many times since the...
A lot.
5, 6, 7 times. So I think at this point, the market's not willing to take that leap. We'll start to price that in when the barrels come off, and I think that's the smart play.
Do you think that the weakness that we've seen is that supply-driven or demand-driven?
This is a great debate. I personally think it's more of a supply-driven issue.
Yeah.
So demand, there's a lot of talk on the street. China demand, it has been a little bit soft. But guess what? India's demand has been stronger. U.S. demand has actually been a little bit stronger. They've offset. Estimates were for 1.4 million barrels of demand growth this year. We're coming in right now at around 1.3. It's not horrible. We do have a lot of supply on the market. Russia is not complying with the OPEC cuts. Kazakhstan not complying. We have a lot of countries within the OPEC group not doing what they said they were going to do. And so we don't have that deficit that we've been wanting to see. It's starting to come through fruition over the summer, but we really need to see it extend into the fall. And I think it's more supply. Widely debated. I think there's a lot of people out there worried about demand. You can worry about demand in the future. Demand right now, what we're seeing, high frequency, not bad yet.
Well, let's stay on supply for a second. I mean, how much is the next OPEC meeting going to matter? I mean, you mentioned all these non-OPEC suppliers, so to speak. Are the OPEC countries, OPEC plus countries, going to matter?
Yes.
Yeah.
So they absolutely are going to matter. And what they do at the next meeting is critical. Do they actually step up and start to unwind those voluntary cuts that they've had in place for years? They're supposed to bring back about 180,000 barrels a day in October. Not a huge number, but the messaging is critical. I think where we are right now in prices, they're not going to do it. Should we rally back to Brent closer to that 80, 85 level? They're going to start to unwind those cuts. They have to. 2025 doesn't look like a great year for supply and demand imbalances. Their window to do this is small, and they need to do it to keep their group together.
I am curious for traders out there and investors, for that matter, too, in this space. We kind of went through this period where it seemed like volatility kind of evaporated out of this market, and for that matter, prices didn't really go anywhere. Now that we're starting to see prices move a little bit more, is that going to be accompanied by a significant uptick in volatility, or would this be maybe a smoother process?
I think we're going to see continued volatility. And we did have that really nice lull where vol was super low and you could just trade that range all day. You could buy the dip, you get a geopolitical event, you sell that rally. I think those days might be behind us simply because we're going into elections. We are going into a critical period for Fed policy. Economic data now is paramount. Every jobless claims is going to matter for crude tomorrow, right? So there's just that more heightened sensitivity to every reading in terms of what it reads. I think that the volatility stays high. I think you can buy a dip in crude and trade the range, but you need to be prepared. The vol is going to be very different than it has been over the last 6 months.
Which does raise the question about M&A and if that prohibits or ignites more M&A in the U.S.
Good question.
And also just the idea that does that actually support or detract from overall production too?
So I think the volatility detracts from production. Generally speaking, I don't think that M&A or decisions about production like to be made during extreme volatility, right? How can you make a decision and feel like you have a good line of sight when things are all over the place? So I don't think it's good for production or decision making. For M&A, I think, honestly, the M&A train is rolling and these guys are going to stay on it. I don't think the volatility is going to change. They see opportunities. They're sucking up the good assets in the Permian. That's going to keep happening.
And you don't think at least here in the U.S., any regulatory issues associated with that?
No, I do think there's going to be regulatory issues.
That means they're not going to do it.
Maybe not, depending on the outcome of the election. Yeah.
We're still going to go for it.
All right, Rebecca, always a great conversation. Rebecca Babin, senior energy trader over at CIBC Private Wealth Group, as we count you down to the close here. And it was kind of interesting, Alex. I was looking at some of the other moves in commodities today. It's interesting. She was kind of saying that the demand issue isn't really an issue right now. But then I was looking at some of the other, like the industrial metals, and people seem to be freaking out about the drop that we've seen in copper and why China isn't buying more, why the U.S. isn't buying more. And I wonder, when does that start to become a bit of a yellow flag?
Wasn't copper, though, that trading really distorted from the arbitrage? So I feel like we've just finally wrung that out at this point. So it's hard to know how much of that was just readjusting from that trade versus actual underlying China weakness.
Yeah. And how much of this is just China and not necessarily more of the other major industrial economies?
I mean, probably when it comes to copper. But if you ask anyone, they're still structurally bullish on copper. Like, there's no way you're not going to be long copper in the next 5 to 10 years with the energy transition.
All right. Well, we'll see.
So I hear.
All right. Well, coming up here, we're going to talk about whether to break up or not to break up. That's one of the main questions on the minds of investors about Warner Brothers Discovery. We're going to preview what to expect from this evening's quarterly report. That's coming up in our top calls. That's up next on The Close on Bloomberg. All right, time now for our top calls. So look at some of the big movers on the back of analyst recommendations. And we start off with Fortinet. Upgraded to hold over at HSBC. The analysts encouraged by the cybersecurity company's forecast for adjusted earnings per share, a forecast that did beat estimates. HSBC also positive about billings growth. The price target being set, though, all the way down at about $59 a share. Those shares, though, having their best day, believe it or not, going all the way back to 2009. Next up, let's take a look at Trex. This is the decking company. It was cut to hold over at Loop Capital, which is flagging a slowdown in sell-through trends that will likely be worse than expected. Analysts also worried about the company's increased CapEx spend on a new Arkansas facility and the impact on margins. Those shares down about 20% on the day. And finally, let's take a look at TripAdvisor, flying down to neutral from buy over at B. Riley, with the analysts saying a deterioration in the core brand's revenue growth and margin prospects a bit concerning. A slowdown in travel coupled with high competition, serious headwinds to top-line growth, and no immediate catalyst in the analyst view up ahead that could turn the tide. Those shares moving lower by as much as 17%. Those are some of our top calls. We do want to stay in the sell side space right now and push ahead to a big event after the bell, and those are the earnings out of Warner Brothers Discovery. Investors and analysts have a lot of questions right now about everything from the loss of that NBA contract to a possible breakup of its assets. Jason Bazinet joining us right now, internet and media analyst over at Citi. He's got a buy rating on the shares. A lot going on with this company, Jason. Let's start first with the cost-cutting efforts, because that's been a big focus here. And expectations are that those cost-cutting efforts will continue. Are you encouraged by some of the moves that Zaslav has taken with those cost cuts, or are you more concerned that that might actually be distracting from some of the, growth initiatives that investors want to see?
Oh, no, I think the cost cuts are good, because we all know that the quantum of dollars you can get in the legacy linear business is just much larger than it is for any streaming business. And so the expenses have to come out of the business as the top line faces pressures.
Well, and the top line definitely going to face pressure because of losing that NBA media rights for those games. What do we expect them to lose on that and that forecast, and can they make it up somewhere else?
Well, it's really interesting. I can't remember how many weeks ago it was, but the market sort of sniffed out that Warner Brothers might lose the rights before they did officially, and the stock was down 10% that day. And it struck me as sort of an outsized reaction. And we went and cranked through the math of how much they would save by not having the NBA, and then how much they would lose. And when you went through that math, what the market was essentially doing was pretty rational. They were saying that the affiliate fees for the channels that carry the NBA content would probably get cut by a little over $1 a month. And that's actually pretty reasonable. So I would say that the market has priced in correctly early that Warner Brothers was going to lose the NBA. And I'm not sure that there's a lot that they can replace it with. I think it's just resetting your affiliate fees and advertising lower.
And that brings us to the question, too, about whether this company sort of stays together in its current form. Jason, do you see any value here in breaking it off? And if so, which pieces?
Well, I think the first principle is the market, I think, correctly has inferred that having sort of all of these assets together doesn't work, meaning a production asset that you feed into linear channels that you also feed into the app. And they're also uncomfortable with a level of debt. And so the home run scenario would be if you could take the production assets and the streaming app and essentially put no debt on them. That would be sort of good Media Co. And then you'd have a lot of debt on the linear business. And as it generated cash flow and shrank, you'd pay off the debt. I think the market would love that. The question whether they'll go down this route, I think, is really more of a bond indenture question, which is, do they have the legal flexibility under those bond indentures to essentially saddle the linear business with the majority of the debt? If they don't have that, then I don't think that they'll do it. If they do, the market would applaud having sort of bad Media Co, a lot of debt, the linear business, and then good Media Co, not as much debt. For the production assets and the streaming app.
I'm sure Zaslav would be totally into that. When you take a look at the stock price over the last year, when are we going to hit sort of like the bottom, the washout for earnings, and we kind of grind our way up from there?
Well, it's interesting that those are exactly the nature of the questions we're getting from the buy side. I would tell you that our thesis, which has candidly been wrong on this stock, is that the enterprise, the multiple, the EV to EBITDA multiple sort of holds, and then the company uses its cash flow to pay down debt, and then that accrues to the equity. Mm-hmm. What's essentially happened is the multiple has just continued to compress. So back in 21, it was 10 times EBITDA. We're now down to about 6. And so at some juncture, the EBITDA multiple can't keep compressing. And so I think this will be true. And those are the nature of the questions we're getting. From my conversations with the buy side, I think most think it's a little bit early, but we're getting to the point when you start trading, I don't know if it's 5 times EBITDA, 4 times EBITDA. It's hard to get your EV to EBITDA multiple much lower.
All right, Jason, appreciate it. Thanks very much. It's going to be very interesting in the next 35 minutes' time. Jason Bazinet over at Citi. The Disney shares, they're higher today, had a mixed earnings release this morning. You got weakness in its theme parks offsetting its first ever profit in streaming. The CFO spoke to Bloomberg about the strength of that streaming business.
3 great motion pictures, the IP that we've produced ourselves, are going to be on the streaming service, as well as an enormous number of Emmy-nominated TV shows. When you deliver that much value to consumers, consumers are willing to pay a little bit more because, frankly, they're getting so much back in terms of entertainment.
But at the same point, have they just raised their prices too far in the theme parks, and they just started pricing people out now?
Yeah, I think this was a cost issue. I don't know why they don't just admit that, but I mean, there was so much anecdotal evidence about that. Also, just a quick correction, Disney shares actually down right now, down about 4%. But it gets to the question, too, is the business, the entertainment business did well. I mean, you saw a couple of their big films.
Oh, yeah.
Including...
You got me Inside Out 2. You got me Deadpool. This is the close on Bloomberg. All right, one stock we are watching into the close is Zillow. It's reporting earnings after the bell. The stock is down by about 1%. I'm totally one of those people that have Zillow app on my phone that I look at all the time obsessively. Mm-hmm. And you have to wonder what kind of demand forecast they're going to put out there, considering we're going to get those drop in rates this year.
Yeah, I wonder if this ends up being a catalyst for buying. And we talk about how there's really been no activity, and first sign you get a meaningful drop in mortgage rates, then obviously people are going to come out the woodwork. And if you buy into this notion that the Fed's going to cut rates multiple times sometime this year, then I don't know, if you're shopping for a home, this might be the time.
Exactly. And speaking of, you got those 30-year mortgage fix coming into 6.22%.
What exactly are you looking at on Zillow?
Me?
Yeah,
oh,
what types of homes?
I have 2.75% 30-year fix.
I know. You tell us that every day, but you're not looking for like a second or third home or something like that?
No, I can't afford it. It's just fun. Okay. It's just real estate attraction. Right. Okay, that 30-year fix dropping the most in about 2 years as bond yields drop. And also, on the way to the equity market, REITs are the best performing sector in the S&P this past month. Joining us now in the studio with more is Laurel Durkay, head of global listed real assets at Morgan Stanley Investment Management. Let's start with REITs. Does that REIT run last?
So, I mean, the REIT market absolutely has been on a tear over the last 30 days, and it's a huge difference from what we've seen over the last 5 years, when REITs were underperforming the broader market by almost 10%. But taking a step back and looking at what happened over the last 5 years, it was COVID, and it was QE to QT. Mm-hmm. right? And so the dramatic hike in interest rates really was detrimental to the cash flows and the underlying fundamentals for a lot of the listed real estate sector. But where we stand today is very different.
So where do we stand today in also light of potential rate cuts?
So I think the question is not if we're getting the rate cuts, it is when and how much. And we have seen that REITs do perform very well in the 12-month period following interest rate cuts. So in the past 35 years, if you look at REIT performance following the rate cuts, they do outperform the S&P in that environment. In fact, it's consumer staples, healthcare, and REITs that outperform after rate cuts in all of the S&P. So we're in for a potentially very positive 12 months for real estate securities.
You have a market pricing right now, at least based on the Bloomberg terminal, a full percentage point of rate cuts this year. You think that's going to happen? That
I think
magnitude?
it's very plausible.
Yep,
I really do.
And when we talk about the benefits of that, I mean, we talk about REITs as this sort of big umbrella, but I assume not everything in the REIT space is going to perform equally once we start to see those rate cuts. What's going to perform better?
So it's at the beginning of the year, I had said we really want to focus on the top-down thematics within the real estate sector that have secular drivers of demand that really will propel growth. So it was technology positively impacting data centers. It was aging demographics positively impacting seniors housing. And it was this housing affordability and housing shortage thing. You're just talking about everyone looking at Zillow but not being able to afford it. That was benefiting the residential rental market. Where I look at today, what I'm most excited about, I think those sectors are still going to do well. But what I'm most excited about are sectors that are going to benefit directly from these rate cuts. And those sectors that are going to benefit directly are ones that have a fundamental positive, that will have an improved cost of capital and therefore be able to really participate more robustly in external growth activities.
Like what?
So look at the freestanding net lease sector, whether it be with retail net lease, gaming net lease, or even healthcare net lease. So a name I really like in this sector is Agree Realty, ticker ADC. It has done very well in the past month, but this is just the beginning for this stock. It's a mid-cap retail freestanding owner developer of single tenant properties, very diversified tenancy. About 2/3 of its tenancy is investment grade. Top tenants include Walmart, Tractor Supply, CVS, TJ Maxx. No single tenant is more than 5 or 6% of their rent roll. Balance sheet is pristine. They have dry powder on the sidelines that they can deploy into properties that they find. And what they have is a disciplined management team.
Okay.
Right? And you don't always find that. But their external growth engine only really works when the spread between where they're acquiring and where their cost of capital is at least 75 basis points.
Okay.
And if it's not 75, it's not going to be accretive enough for the underlying shareholders. So the past several years didn't really work out as well as it does now.
Yeah.
Where we're in that green zone and the company is going to be deploying this capital.
All right, well, that's definitely a new one for me on my radar. We'll keep an eye on that. I am curious as well about your thoughts on general office real estate. I mean, there was a lot of talk, obviously, about all the gloom and doom, that we were headed for some implosion. That implosion didn't necessarily come, though there's still a lot of stress out there. What is the state of commercial office real estate, and would a series of rate cuts solve some of those issues?
So office is an interesting sector, and I would say it's very divergent among cities across the globe, and then even within those cities, within particular submarkets. So you have some submarkets that have vacancies of 5 to 10% here in New York City, for example, whereas the overall vacancy of this market is closer to 25%. What we have seen unfold in the last quarter is outsized leasing that really surprised everyone's expectations. And that is, I believe, an indicator that the office market is not dead. You just need to be a little bit more discerning when thinking about what office property you want to invest in. But you have certain submarkets, including Park Avenue, Grand Central, that really is seeing increasing rental rates, declining vacancies, and it's a great fundamental backdrop.
Because it's right next to Metro North, too. It's like if you go to the transportation area, that seems to make a lot of sense for commercial real estate. Now, you mentioned what you do like. What do you do with like AI data centers, warehousing, like sort of these, structural changes that we're going through, still in a cyclical market, though?
So I'm still very positive on the overall data center sector. I think that you have seen the companies perform pretty well this year, and that's across the globe. And that's really predicated upon the artificial intelligence demand that is really fueling data growth for these data centers. And it's coming at a point in time when you have supply coming in much below what is necessary in order to meet this AI demand. And the reason why supply is more limited today is because we have power availability challenges. It's not necessarily power generation, it is power transmission.
Yes.
The grid simply cannot support the amount of power that is required to fuel these data centers to really meet the AI demand. So when I look at the fundamental picture for data centers, really for the next several years, I think that these secular demand drivers are going to significantly outpace even the most bullish expectations, and they're still going to be good stocks to own.
All right, Laurel, going to have to leave it there. Great conversation. Laurel Durkay, one of the best in the business, head of global listed real estate assets over at Morgan Stanley Investment Management. Counting you down to the close right now. Just about 21 minutes to go here, Alex. And it's interesting, too, she ended on data centers there. I know in a few seconds we're going to talk about Supermicro, which is taking a huge leg down because of some concerns about their earnings in the here and now. But there was a weird story there because their forecast was very bullish in terms of revenue growth coming out of AI data center growth.
Well, it's going to be hard for me to understand how to take the reaction function of the stock market for earnings right now very seriously because we're in this weird phase. Like, are we still in are we in a downtrend that's going to be for real? Or are we still in an uptrend and this is a pause? And that's going to really also determine the reaction function of these stocks.
When you were on Zillow, did you actually look at commercial properties as well to save the office space?
That's stupid and boring.
So,
no,
right.
Why would I do that? No, I'm looking at the penthouses I'm never going to be able to afford with like the pools and like the upside thing.
Nobody lives in those things anyway. All right, coming up here is a sharp reversal for shares of Supermicro. We're going to dive deeper into that story when we come back. It's our stock of the hour. This is The Close on Bloomberg. Taking a look at some of the big movers right now. Topgolf Callaway, ticker MODG, plunging about 12%. Hard to know exactly what's going on here, but they were scheduled to report earnings after the bell tonight. It looks like some type of earnings presentation was inadvertently posted online. Now, if you believe those numbers as they are crossing the Bloomberg terminal right now, it does look like they missed on some key revenue numbers, both for the current quarter as well as for their guidance going forward. I'm not going to read those numbers to you just because we want to make sure that all this is correct here, but the knee-jerk reaction is a huge downtick here in the stock, down 12% here, Alex, as we move closer to those closing bells.
All right, let's get to our stock of the hour now. We're watching shares of Supermicro. That stock is down by almost 20%, reversing some major gains this year. You got weak profits foreshadowing its strong outlook. Bloomberg's Abigail Doolittle has more. But Abigail, it was really about margins that seemed to be the problem here.
It was absolutely about margins, and I would also say it's about how much you were mentioning that the stock was higher on the year. Between January 2nd and March 8th, up 337%. So that's the degree of perfection priced into this stock.
That's it?
That's it. If you only want 300% in 2 months, but it's been trickling down since then. So in terms of the quarter that was, you were mentioning margins. The gross margin came in at 11.3%. Their long-term goal is 14 to 17%. Apparently, what's really weighing on that margin is the mix shift, like the products that they were selling, plus higher production and supply chain costs and a more competitive landscape. But then on the other hand, you have this guidance guidance that is really pretty great. 87% sales growth. They're really targeting the midpoint of their sales range of coming in at $28 billion. That's an interesting thing, though. It is the midpoint. So the range for next year, $36 to $30 billion, right in the middle. I think, again, the stock was up so much, and I just received feedback on Twitter, X, that I should stop using the phrase too far, too fast. But how else do you describe up 337% in 2 months?
Yeah. Well, pro tip, just ignore anybody on social media. But I am curious, though, too, about the guidance, because I thought the guidance was strong.
It's strong.
And you would think that would
robust.
please investors, because it's kind of a continuation of that AI steam. The idea that there is something in the tank. Now, whether they have the operating margins that go along with it, but the idea was everyone thought maybe the bloom was off the AI rose. They're basically providing a forecast saying, look, data centers are still hot.
Yeah.
And I think everyone we talk to seems to think they're hot.
I think I don't think that there's any disagreement with this. I think, again, when you put it into the context of the environment with the stock up so much and then the last month of a bit of risk off, folks want perfection. If the companies aren't hitting the numbers that they're expected to hit, then they're going to move on to companies that do. I mean, put this into context. So today we're down almost 20%. That's only the worst day since April 19th. That's how many big moves this stock has made. And I would say since it's been added to the S&P 500.
Do you look at the 90-day volatility on this stock? It's insane.
No, I didn't. Is it crazy?
Yeah,
it must be. I mean, it's
like Tesla from the old days almost.
It's pretty wild.
But I should point out, Supermicro is still up 73% so far this year. It's the third best performing stock in the S&P. All right, Abigail, thanks very much. We really appreciate that. We are counting it down to the closing bells. 15 minutes to go on a, what do we decide, Wacky Wednesday? Wilting? I'm going to go wilting on this
Wilting
Wednesday. Emily Leveille is portfolio manager over at Thornburg Investment. There we go. In management. She'll join us next.
Bottom line, we still think there's opportunity within pockets of small caps, particularly those that are higher quality, have been able to beat and raise, see upward estimate revisions. But for the Russell 2000 overall, we think it may be a challenging period. Sticking with large caps for the near term may be more prudent.
Jill Carey Hall there over at Bank of America Securities, kicking us off to the close just about an hour ago. We started the day. It looked like we had an extension of yesterday's rally heading into Tuesday here. But as we march closer to those bells, Alex, you can see it there, red, pretty much across all the major indices.
Yep, although the VIX is a little bit lower, but we're still about 27. And small caps underperforming as well, off by almost 1%. So it feels like we're just back to selling all the stuff. But this time we're also selling bonds rather than buying bonds as a safety. Yeah, a slight uptick in yields, mostly on the middle and the longer end of the curve here. Your 2-year yield, though, back up to right around that 4% level, briefly trading above it earlier in the session. Let's keep it rolling now as we move closer to those closing bells. 9 minutes to go. Emily Leveille joining us, portfolio manager at Thornburg Investment Management, joining us here in Studio 2 in New York. Great to have you.
Thank you. Thank you so much for having me today.
We have to kind of ask you about the elephant in the room, and that is interest rates and the Fed, and will they cut, how much they're going to cut. This is a market that seems pretty convinced right now we're going to get multiple rate cuts before we get to the end of the year. That seemed to be the catalyst for the rally, but to a certain extent, it also seems to be a catalyst for part of the sell-off that we had as well.
It's like bad news is bad news again.
Yes, finally.
No, we absolutely think we're in the later stages of an economic cycle. And I think you saw that with, mixed consumer data last week, but marginally weaker. I think that what the market is going to be looking for from here until September is the jobs data, the inflation data, maybe taking a little bit of a backseat. But I think we're definitely in a slowdown, and it's just a matter of, how fast and when we start to see continued slowdown in the consumer, at least in the United States.
How much do you, or I guess how confident do you have to be right now to enter new positions in the equity space? And if you are confident enough to do that, are those positions idiosyncratic? Are they more macro? What?
Well, we're fundamental active investors, and so we see these moments of volatility as moments of opportunity. And so we absolutely are looking for, to add to positions where we think the earnings power continues to be underappreciated by the market, and to new positions where we see potential opportunities emerging. I would say we're definitely looking at those idiosyncratic growth drivers. We want to invest in companies that are going to be able to grow and maintain their earnings power throughout an economic cycle, and they're not going to be as tied, particularly to what we see is some weakness in the consumer in the U.S.
All right, what do you like?
Well, we still really like the AI trade because we do think that we're in the very, very early stages of the build out of AI infrastructure. So in a certain sense, the AI investment that needs to happen is going to march to the beat of its own drum. And we saw that in the earnings from the cloud service providers in the last couple of weeks. A confirmation that they're seeing revenue stability, a little bit of revenue acceleration, even some revenue coming from AI. And also that they're accelerating their CapEx spend. So that gives us security that, the demand for chips that we need to go into these AI data centers, they're going to be there. So we like TSMC outside of the United States. We like some of the niche players that are important equipment providers, ASML, Bezi. These are all sort of at the leading edge of the AI build out. The other area that we really like is healthcare. So we talked a little bit about, GLP-1s and Novo Nordisk. The stock was a little weak on earnings today, but fundamentally there are 1 billion people that suffer from obesity today. That number is only going to grow. And we've seen just the tip of the spear in terms of the number of people that have been able to get treatment from Wegovy and Ozempic.
Well, but sorry, can I just follow up on that? But is that going to benefit Novo? Because it seemed part of the sell-off, the concern, at least amongst investors, was that you've got a lot of new entrants into this market. There are a lot of other weight loss drugs in the pipeline here, so that while the pool of people taking it might expand, that doesn't necessarily mean their percentage of market share for Novo or for any specific company is going to grow, is it?
That's true. Yeah. However, I will say Novo, we believe, has a first mover competitive advantage, both Novo and Lilly. Yeah. Novo also has a very strong pipeline of new drugs, so they'll be coming out with trial data later in the year for their next generation weight loss drugs, CagriSema. Novo has been very focused on running trials to expand the applications of this GLP-1. So we've seen them run trials and continue to run trials on kidney disease, on heart disease, on a number of different indications, what we like to call a company that has a pipeline and a product. So they're able to take a drug that they've developed and then potentially use it for different indications and expand that earnings potential for the business over a really long period of time. So we think Novo will continue to be a key player in the space.
So what stock might you not like anymore that you may have liked at the end of the year?
One of the names or one of the areas that we've been focused on where we have exposure that is, exposed to the United States is in the luxury space and what we call sort of maybe more mass luxury space. So LVMH is a name that, and just, generally the consumer space is a name that we're steering clear of for now. We think this is a great long-term business with a very strong platform of brands. But what we've seen from Amazon, we've seen from L'Oreal, we've seen from Nestle, is everybody is talking about how the consumer in the United States is trading down. And so we think that if you're going to be in the consumer space, you want to be at the ultra high end of luxury, the Ferraris, the Brunello Cucinellis, or you want to be in the value for money
as well.
Well, me too.
I'm not going to pay $1,000 for a sweater. I do not get it. But anyway, I dig.
There certainly are people out there that can, and they're a lot less affected by the jobs market than the rest of us are.
Just real quickly, only got about a minute left here. I am curious. I saw in some of the stock picks that you had several in that kind of the IT services area, and I know some of that links to AI. Explain that.
We think that IT services is an area of the market that's been really an underappreciated beneficiary of AI. So, you heard Andy Jassy talk about this on the earnings call from Amazon that, this is a process. Enterprise use of AI is going to be a process involving a lot of data transformation. High quality data is going to be needed. All that sort of lifting and shifting that we've seen from enterprises moving data from on-premise to the cloud, you're going to continue to see. And so companies like Globant, companies like Accenture, we think are going to be businesses that are really going to be key to that transformation of the data so that enterprises can use those large language models to benefit their businesses.
All right, great to have you. You're going to have to leave it there. Emily Leveille, portfolio manager of the $830 million Thornburg International Growth Fund. As we count you down to the close, just about 3 minutes to go, Alex, we should point out that as we were talking, stocks actually hitting fresh session lows now, down to more than 1% right now on the NASDAQ indices, down more than 1% on the Russell, down more than 1% on transports, and the S&P 500 right now down about 0.8%.
Yep, here we go. And we also get some earnings out after the bell as well. Obviously, Warner Brothers, we talked about that earlier, but we also have Zillow coming out. We have Occidental. We also have Robinhood. So we're going to get a nice smattering of earnings coming out in the next about 15 minutes time as we really wind down here. NASDAQ off by over 1%.
The VIX right now camped out around 23.9 and change right now on your 2-year yield. Your 10-year is still below that 4% level here, but a lot of weakness across the board, a lot to break down as we get closer to those bells. Full market coverage coming up right now, right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here alongside Alex Seal. We're taking you to the closing bell with a global simulcast starting now. Scarlett Fu joining us in the TV studio, Carol Massar and Matt Miller in the radio booth as we welcome our audiences across our Bloomberg platforms, including our partnership with YouTube. Carol Massar, the turnaround Tuesday turning into a bit of a wobble on this Wednesday. Stocks now at session lows.
Yeah, right. Really interesting from how we started the day to where we are right now with just a few minutes to go. Having said that, you and I, Matt, have been talking a lot about the semiconductor space. Just the swing that we've seen, that group has been down more than 3%, and it's been up as much as almost 4%. So you're talking about a 7% swing, Scarlett.
Yeah, definitely. And I think it's notable here that we started to see equity indexes give up their gains well before the final hour of trading. Yesterday, if you'll recall, we had a swoon into the close. We still finished up, but definitely off our highs. Now we've completely given up our advances. And Quincy Cosby was telling us earlier that that's a real sign that this unwind has more to go.
Yeah, and that in many ways doesn't surprise me at all. JP Morgan Market Intelligence this morning had their note out, and I love this quote, you guys. They were saying that basically this was a sell-off that was coming. It was just disguised as a growth scare. And if that's the case, you can obviously say that there's a lot more downside to come then. We haven't really reversed that 200-day moving average for the S&P.
And as a lot of our guests point out, too, I mean, a lot of this might also be just profit-taking, good old-fashioned profit-taking when you consider the gains that we've had through the first few months of the year.
Yep, indeed. And you're taking a look at the indices really rolling over here. You're looking at the S&P off by about 0.8%. Now, to me, the question is, guys, what happens into tomorrow?
All right, well, let's talk about today for 1 second here as we get the closing bells in New York right across the screen, which is a big turnaround from where we were at the start of the session when it looked like stocks were set to rally 1 or 2%, closing lower by about 1% across the board. The Dow Jones Industrial Average down 0.6%, S&P down 0.8%, NASDAQ down more than 1% on the day, and the Russell 2000, Carol, going to close out the day lower by 29 points or 1.4%.
All right, so back to the big caps I go, as you know I like to do. Most names, guys, lower in today's trade by the end. Very different picture again at the open today. 358 names in the S&P 500 losing ground today, Scarlett, 144 to the upside.
Yep, and in terms of the 11 sector groups in the S&P 500, 7 of them are lower. Consumer discretionary, materials, and infotech leading the way down, each losing at least 1.33%. Your outperformers here are really your traditional defensive groups. Utilities up 0.5%, energy gaining about 0.5%, financials barely positive, and staples unchanged to barely positive.
All right, guys, to the individual gainers we go. This one, number one gainer in both the S&P 500, the NASDAQ 100. We're talking about Fortinet. It was up 25% in today's session, jumping as much as 27%, biggest intraday rise since about November of 2009. So quite a bump to the upside. Company forecasted adjusted earnings per share that beat estimates. Analysts also are really positive about billings growth and note that margins were the strongest metric in the second quarter report. Axon Enterprise, also a major outperformer, up about 18% in today's session, top in the S&P. Company makes tasers, they make body cameras, boosted its revenue guidance for the full year. Yes, the guidance beat the average analyst estimate, so some really outperformance. One more for you, Latham Group. Ticker, great tipper. Ticker is SWIM. Company makes and builds in-ground residential pools. It reported adjusted EBITDA for the second quarter exceeded even the highest estimate among analysts tracked by Bloomberg, so some really outperformance there, Matt. So
you ever been tased?
No.
Any of you guys ever been tased?
No.
It is a pretty interesting experience.
Why have you been tased?
I tased myself once when I was working as a security guard in a Russian disco in southern Germany, just to see what it was like.
It's coming in the Netflix documentary on Matt Miller. All of this will be
Let me get to the decliners here.
Me too.
Super Microcomputer, the biggest decliner. And I think this is a fascinating sort of picks and shovels play on AI because the stock has grown so much faster than NVIDIA and now come crashing back down to about the same gains, but they had margins that disappointed analysts. So a big drop in Super Microcomputer today. Airbnb, the biggest drop on record. As much as 14%, the shares came down 13.4 there at the close because they had a disappointing bookings outlook. And then Disney, I think this kind of tells the story of the consumer, what we saw yesterday from TripAdvisor and Airbnb and Disney, is that they're just not going out and making these bookings. They're not going to the parks as much as Disney would like. They did have people staying home and buying Disney Plus or watching Hulu, watching ESPN, but they're not seeing the growth that they want at the parks. So the real question, I think, from earnings over the last 24 hours is about consumers.
All right, guys, speaking of consumers, people watching Warner Brothers, let's get to their earnings just crossing the Bloomberg terminal. Adjusted EBITDA for the second quarter, $1.8 billion. The estimate on the street was $2.07 billion. Cash and cash equivalents, $3.61 billion. The estimate was for $3.21 billion. We did see the stock, initially I was looking at it in the aftermarket, coming a little bit lower. We'll bring it up for you in just a moment. What's interesting is what we really want to know about is them losing out on the NBA contract, that $76 billion deal that we saw that the NBA struck with Disney and Comcast and Amazon, and they're fighting that. Right now you've got Warner Brothers down. Well, now it's unchanged, but we saw it down about 3.5%. They right now, Discovery, are suing NBA, though, for that alleged breach of contract.
Yeah, and it's interesting. We spoke with Jason Bazinet over at Citi earlier today. He actually doesn't think that the loss of that is going to be as damaging, at least on a financial basis. I think he said something like maybe $1 or so, maybe shaved off the bottom line, but he actually, on a per share basis, obviously, but he thinks that will be recouped through other initiatives, cost initiatives that the company is taking.
Yeah, Warner Brothers shares bouncing around here from unchanged to down slightly following that $9.1 billion charge. A quick mention here of Duolingo, which is the company that provides software to teach languages. It has boosted its full year revenue forecast. The stock up slightly right now. Second quarter revenue for the period that ended, $178.3 million, beating the average analyst estimate. But again, that third quarter outlook does top the average analyst estimate.
I want to go back here to Warner Brothers. If you take a look at direct-to-consumer subscribers, they came in about 103.3 million. That's at the end of the second quarter. That was an increase on a sequential basis. But guys, their TV revenue is down 27%. Yeah, their theater revenue was up about 19%, but their TV revenue down 27%. And their cash burn was pretty, well, they repaid a lot of debt, actually. So they ended the quarter with about $3.6 billion of cash on hand.
Yeah, we actually heard this recently from a debt investor that the company, the shareholders are going to have a real problem, especially if they're able to do this spinoff. But he said he liked the company as a debt holder. Writing off your entire TV networks business for $9.1 billion is definitely not the kind of thing that you want to see if you're holding the stock, right?
Yeah, well, I mean, to be fair, it was sports and the ad market, so I guess it was a combo there. All right, just taking a look at Zillow here, you have revenue coming in at $72 million, I should say. That was definitely a pretty strong beat, and their outlook for the third quarter also coming in higher than estimated at the high end, looking at $560 million. In terms of an adjusted EBITDA, if you just look out to the third quarter, they're also looking on the high end of $110 million. So relatively solid. That third quarter EBITDA estimate, though, is a little light, even though the revenue is higher. The CEO, though, is stepping down, will be replaced by the current COO. So the current COO will be CEO Jeremy Waxman will be joining Zillow there at the top. Yeah, that Zillow CEO stepping down for the second time, right? Like he's been trying to reinvent the company. He's been trying to grow the business, but it's been really difficult in that sluggish housing market. So you're looking at Zillow, though, nonetheless, up more than 5% here. Let's go to Robinhood. The shares higher in after hours, trading by about 3.5%. Earnings across the wire right now. 2Q monthly active users coming in a little bit light, 11.8 million. The street was looking for 13.2 million. Though we should point out revenue did come in above estimates at about 682 million. Not necessarily seeing a forecast here, although the company does say its full year operating expenses will still be in the range that they had forecast previously here. But overall, it looks like assets in custody, whether you're talking about on the equity side or on the crypto side, beating estimates here. So did the bottom line. The shares higher by about 3.5%.
Take a look at Bumble shares if you want to know what happens to a company that cuts its full year growth forecast to almost nothing from 10%, right? Bumble had seen growth of 8 to 11%. Now they're coming out and saying revenue is going to actually just grow 1 to 2%. The street was looking for 8 and change. The shares dropped by about a fifth. No, about a quarter. Now, Bumble did actually have profit that beat in the quarter and revenue that was basically in line. They say they have 4.14 million users. That's also in line. Did you guys see the Ashley Madison documentary?
No.
See that?
No.
Not yet.
You should definitely watch it.
Okay.
Anyway, Bumble, they have paying users, more than 4 million, but they don't expect sales to grow more than 1% to 2%. And as a result, the stock is taken down by half, or by a quarter, I should say.
Okay, so in the press release, they say that we are resetting our guidance today to reflect actions we're taking to position Bumble to reignite user growth, deliver improved customer value, blah, 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 drive long-term revenue growth. I mean, you know, the usual happy talk. But resetting our guidance today, like you said, Matt, it's a pretty big reset to go from anywhere from an 8% to 11% to 1% to 2%. I mean, they did not give analysts any kinds of heads up if analysts were looking for 8.4% on average.
Free cash flow down 23% year over year. I mean, it's not a good trend.
I can't believe you haven't seen the Ashley Madison
All right.
documentary. None of you has been tased or seen the Ashley Madison documentary.
No, we're 0 for 2 here, Matt.
Putting it on the list.
That's a Matt Miller combination.
Get tased and watched the Ashley Madison documentary.
Right? Yeah, it is.
Exactly how I want to spend my Friday night. All right, that's a wrap, guys. Bumble down almost 30% here in the aftermarket. Warner Brothers down about 6.6%. Zillow, a gain of about 6.5%. All right, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. Alex is heading out. Scarlett and Romain finishing up on television. And you and I are going to finish up on Bloomberg Business Week. Folks, we will see you again, though. Same time, same place tomorrow.
And we continue our coverage right here on Bloomberg Television. A slew of earnings crossing the wire. A full breakdown when we come back after the break. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
Romain Bostic here. We talk about that turnaround Tuesday turning into, well, a bit of a walk back on this Wednesday here. What was the catalyst? Hard to say here. Remember, the stocks opened higher earlier on the day. Largely, that was because of some relatively dovish comments out of the Bank of Japan. You saw that reflected in the moves in dollar yen, and that fed into the equity market here in the U.S. But that began to fade later in the day as a lot of people started to think about what multiple rate cuts really means. Is that a sign of economic weakness? The S&P, the NASDAQ, all finishing lower on the day. In fact, the numbers you're seeing are pretty much the lows of the day, minus a tick or two here. You really saw the small and mid caps really get affected today, and also a lot of concerns going on in industrial metals today. Scarlett's copper down about 2%.
And the earnings picture has been mixed and negative, especially for some of the more household names, right? CVS Health down 3% on the day after it cut its outlook for a third straight quarter because of rising medical costs at its Aetna insurance business. It also announced a multi-year $2 billion cost-cutting plan. So that stock certainly not a great sign for healthcare companies overall. Airbnb losing 13% on the day. That is the biggest decline ever as a publicly traded company. It gave yet another disappointing outlook and warned of slowing demand from U.S. vacationers, clearly concerning given that this current quarter is the peak travel season for the company. Airbnb, by the way, is now positioned for the slowest growth since 2020, the height of the pandemic. And Fortinet actually bucking the trend here, up 25% on the day. This is the cybersecurity company. It gave a forecast that beat analyst estimates. And this is on top of the fact that second quarter billings were better than feared, and margins were actually the strongest metric in its results. Investors particularly impressed by that. Romain?
All right, let's get back, of course, to one of the big names of the day, and that is Warner Brothers Discovery. Those shares oscillating between gains and losses here in the after-hours trade. A big miss here on the revenue side, but more importantly, a huge write-down here as that company looks to right the ship. Chris Palmeri joining us right now from our Los Angeles bureau. And Chris, everyone's focused right now on that $9.1 billion charge. What is that charge for, and are we expecting to see more?
Well, Discovery, as it was called back then, made a big acquisition of Warner Brothers just a couple of years ago, $43 billion, brought together all these famous cable networks, CNN, TNT, and that. And what they're recognized today, basically, is that they've declined a lot in value. This is a reflection of what's been happening. All of us are watching things on streaming, and they're not on cable TV. Advertising's down. The fees they get from cable operators are down because customers are cutting the cords. And this is going to be kind of a watershed moment, I think, in this whole migration from traditional TV to streaming. This is just a wipeout of some of those glorious old names.
Well, I am curious then, actually, Chris, what is kind of the turnaround or the growth story, if you will? Have they articulated one? Certainly, I didn't see it in the release today, and I know we still have to wait for the conference call, but what is that growth story?
Well, much like Disney's this morning, they had some good news in the streaming business. They added more subscribers than the Wall Street forecast, and now well over 100 million globally. Advertising there was also on the streaming business doubled, although from a much lower base than in traditional TV. So that migration is happening, but it's still painful for the old businesses.
And in terms of the financials, I'm looking at free cash flow down 43% from a year ago, Chris, to $976 million. Analysts were looking for somewhere in the neighborhood of $1.18 billion. I know that Warner Brothers Discovery has a lot of debt, and David Zaslav is very intent on reducing that debt burden. His pay his discretionary pay at least, is pegged to free cash flow. Tell us a little bit about the progress or lack of progress Warner Brothers has made on boosting its free cash flow.
Well, that's something they have been talking about a lot on earnings calls, and they have paid down some of the well over $50 billion in debt when they first did this merger. But, there's troubling signs even beyond the traditional TV business. The TV studio had a big decline in profits as well. Part of that's probably related to the strikes. Part of it is that Warner Brothers, like a lot of media companies, are trying to cut back on spending. But, I think that analysts will very likely on the call coming up ask David Zaslav exactly what's happening with the profit business at this company.
Yeah, those will definitely be the questions directed towards him. Chris, thank you so much. Chris Palmeri, covering the media and entertainment industries out in Los Angeles. Now, another stock that we're watching right now is moving in after hours, and that is Zillow. It is higher after its second quarter numbers, and one of the big headlines here coming out is a change in leadership at the very top. The CEO, Rich Barton, is stepping down from the top job for a second time. Bernie McTernan is senior analyst at Needham, and he joins us now. Bernie has a hold rating on Zillow. So, Bernie, what does it mean that Rich Barton is stepping down once again for a second time? Because his second time around did not seem to get done what he had intended.
Well, I think it's important to remember that, he got the company into iBuying and then stayed with the company to really focus on the core and the goal of going out and doubling their market share. I mean, you're seeing some proof points of that come through this quarter. Residential revenue grew 8% versus the housing market growing 3%. So I think that's the key for the company now, is to focus on these enhanced markets and how to really grow their share, not only of buyer leads, but importantly, seller leads as well, too, as this industry is going through this transition. But certainly was a major surprise. We were not expecting to hear this news today.
I am curious. I don't know a whole lot about Jeremy Waxman. He's obviously the COO. He's been there for some time. Do you think that's the right move to elevate him into that CEO role?
Yeah, I mean, look, he's certainly been with the company. He's been, learning under Rich. And again, it seems like the company's in a pretty good spot. I mean, this has been an extremely difficult housing market now for years. I mean, at this time last year, we probably would have said we would be looking for housing market growth this year. That's not going to happen this year. We think that's more of a 2025 event at this point. So again, I think Zillow has the right strategy to really focus on the core. They have the right assets in place. Now they're growing out their enhanced market base. So again, I think, Jeremy, it's just to continue the strategy the company's been adopting over the past year or two.
There's been some obviously big changes in the industry that Zillow exists in, and that's how buyers, sellers, and real estate agents transact, how these agents get paid when there's a transaction in the home market. What do you expect to learn from the management when they hold their earnings call on how they're adapting to this?
Yeah, no, it's a great question. And I think that's the most important question facing Zillow and in any portal right now, where it's that, what's the LTV of that buy-side lead? And if broker commissions are going down, all of a sudden that LTV is worth a whole lot less. And then therefore brokers would be spending less on advertising with Zillow. What we've heard so far, like Redfin reported last night, for example, and others in the industry, like Compass reporting the week before, is that there hasn't been a significant change in broker commissions, and nor they expected to. Remember, this goes into place officially 10 days from now, but we've already seen some MLSs start to adopt these changes already. And so it doesn't seem like there's going to be a massive step function change coming 10 days from now, but certainly given the guide from the company, it's in their ability to their growth in the second quarter, we think that everything's probably going to plan, but that will certainly be a big topic of discussion on the earnings call that's starting soon.
When we talk about just kind of the whole structure of these businesses, not just for Zillow, but obviously its peers as well, Bernie, I mean, kind of paint a picture for us of where you think their growth will come from. Is it just about getting more people onto the platform, or do you see a way where they can take their existing user base and find a way to monetize it better?
Yeah, well, I mean, don't forget where we are right now in terms of the housing market cycle. So getting back to mid-cycle, call it 5.5 million existing home sales. That's 30% upside from here. So that's a big driver for the industry. And then in terms of just being able to, Zillow, everyone starts their journey at Zillow, but Zillow making sure that they're the ones finding you an agent. Importantly, they want to be the ones finding you a seller agent as well, too. That's a major focus. So while the housing market's waiting to recover here, I mean, our top pick in the space is actually Compass, not to pivot there, but we think that not only can they benefit from the upside in terms of housing market returning, but also they're going on the offensive too, trying to take market share within the brokerage industry.
All right. Got to leave it there. Bernie, always great to talk to you. Bernie McTernan, senior analyst over at Needham. A closer look at Zillow. The share's actually moving higher on the back of this with the CEO stepping down. We should point out he's the co-founder of the company. He was kind of brought back in to kind of right the ship from the last problems they had. And I guess now he feels comfortable enough walking away. And at least based on the share reaction, investors comfortable with it as well.
Yeah, and we'll wait to see what they say in the earnings call. I don't know about you, but even if I'm not looking to buy a home, I go on Zillow a lot to see how much my property is worth or how much my neighbor's property is worth, those estimates. But the scuttlebutt on those is that they're a lot rosier than some other websites, right?
I just do that
the estimates are always super bullish.
Oh, yeah. I just do that like when I go, like somebody invites me to their house for dinner or for a party. Then
it's your due diligence ahead of time?
And then I hate them afterwards. And I realize, wow, they can afford a $4 million house? Like, what the heck? Anyway.
And you work that into the conversation somehow.
No, I just stare at them passive aggressively for the rest of the night. The interesting thing, though, about it is, like, we talk about, Bernie was talking about this idea of how Barton really kind of fixed iBuyer, well, by fix meaning got rid of it. But then now you're starting to see, because they kind of got squeezed by that rise in interest rates, but now the interest rates are coming back down, you kind of wonder if maybe they want to get back into that or they just moved on.
I think at this point, probably better to move on and see what the next regime looks like.
All right. A lot to talk about here. A lot of earnings crossing the wire. We're going to dive deeper into that after the break. Bumble shares having an awful post-market trade. Dutch Brothers not doing a whole lot better. You have some bright spots out there, including Beyond Meat and Monster Beverage. Just took a look at that, Scarlett, down 5%. Stick with us. This is The Close on Bloomberg.
All right, we have been hit with a wave of earnings, so we got you a roundup of some of the most meaningful movers right now. And to do that, we have our Bailey Lipschultz and Emily Graffeo. And I got to start with Bumble because the guidance that the company gave is pretty stunning. It's looking for almost no growth for the full year, when previously it had anticipated on average 9%.
Yeah, they see revenue now up 1% to 2% for the full year. And like you said, that estimate was for 8.4, and they previously saw 8 to 11, and we're seeing that stock down about 30% after earnings. This is a similar, maybe not as bad. Yeah. We didn't see as bad a story with Match Group.
Yeah.
But it was a similar story of people pulling back.
But the same trend was there, that people just aren't using it, particularly younger people. I guess they feel
Gen
like they're
Z
not
doesn't
getting
do
enough, or they're not getting as much out of it. I feel like, don't stop blaming Gen Z for everything. Blame IAC, blame Match, blame these companies because they switched up these apps and they're awful. I was helping a friend. We were actually helping a friend, and she's an older woman. We were trying to help her get back in the game, and it was kind of a pain. Like we were doing her stuff for her, and it was just like, I don't know. It was very confusing.
And now
we're old, so maybe younger people get it. But anyway, we got to move on here. Another stock that's moving is Monster Beverage. You drink those things?
No, it's bad for your heart.
It's just cans, right? It's just cans of caffeine, and then you just do a little.
It's like basically, it's like Mountain Dew on steroids. It's a Red Bull competitor, but it's under pressure right now, down 10%, missing expectations. Revenue rising, but earnings falling short. When you look at the energy drink net sales, 1.74 billion. Street was looking for 1.8 billion. Romaine, back in the day, this was like the top performing stock ever.
Yeah.
But when you look at it even just on a year-to-date basis, peaked out in March, $60.85, now trading at 46 handle.
And just before we pivot here, too, I mean, just going to Emily's point about trends with like Match and kind of how that maybe foreshadowed Bumble. We also had Celsius, I think it was yesterday or the day before, and they also talked about some of the same trends that they're seeing some softness there. So not necessarily specific to Monster.
They do, but Celsius is picking up market share at the expense of Monster, right?
And the interesting thing, too, though, is that Celsius, to your point, Scarlett, is catering towards a younger audience typically. But the interesting thing from my understanding,
in that one?
I think they're kind of the same. But the thing with Celsius is that people are buying that at grocery stores. Monster drives so many of their sales at gas stations. So when people are traveling and road tripping, you're getting an energy drink and maybe getting a bag of chips, or at least I'm not. Maybe you are.
Gas stations. Do you spend a lot of time at gas stations?
Oh, God. I don't. I mean, I don't have a car. You don't drive in New York City. I don't even think a gas station
Have you been to a gas station in New York City? No one hanging out at gas stations in New York City has a car. They're just there doing God knows what. Dutch Brothers, by the way, if you want real caffeine.
Right,
shares,
exactly. Those shares plunging. And that's kind of like a drive-through franchise, too. So I don't know what that's showing us about the consumer.
Not available in New York, though.
Not available in New York. And actually, the earnings weren't that bad, but.
All right, we got to leave it there. Emily Graffeo, Bailey Lipschultz, a closer look at some of the earnings. We'll be back. This is Bloomberg. All right, let's take a look back in history. On this day, back in 2018, Elon Musk sent a succinct 9-word tweet that rocked the world. It read, "Am considering taking Tesla private at $420, funding secured." It was the start of a multi-hour tweet storm that sent Tesla shareholders on a multi-year roller coaster ride. Drama that started about 30 minutes earlier with an unsourced news report that the Saudi sovereign wealth fund had built a $2 billion stake in Tesla. Now, it all concluded hours later that day with a blog post on Tesla's website that said if the decision to take Tesla private didn't depend on a shareholder vote, it would already be official. Now, let's just state the obvious. From the start, the plan was absurd. If not for practical purposes, certainly for financial reasons. $420 a share ascribed an enterprise value of about $80 billion to the company at the time, which, subtracting Musk's then 20% stake, meant about $66 billion would needed to be raised to complete the transaction. That would have been then and would still be now the largest leveraged buyout in world history by a mile. Now, the lack of details about the funding was also a head-scratcher, and while the stock did rise 11% that day, it closed around $379 a share, 10% below Musk's $420 strike price. And at that point, investors had become numb to the spitfire nature of Musk's leadership. Ultimately, the tweet storm, it led to multiple lawsuits and brought Musk the attention of the SEC, which did broker a deal where investors would recover about $12,000 each. Well, that's about $40 million in total for the losses incurred from that fateful day back in 2018. 90-day historical volatility on Tesla stock has already been wild. We talk about a stock here that was trading at 3 times that of the NASDAQ 100 on the volatility basis. Average daily changes were about 2.5%, which compared with the S&P of about 0.7%. And while Musk in that memo to employees said privatization was all about creating the environment for Tesla to operate best, Wall Street raised a lot of questions as to whether that idea was more rooted in personal grievances around short sellers. Nevertheless, all that drama, well, it actually kind of worked out for some shareholders and certainly for Elon Musk himself. Tesla shares have rallied almost 700% since that day, and Musk has added almost $200 billion to his net worth to make him the most richest person in the world.
Yeah, well, Elon Musk and 420, he likes that number for many, many reasons. But I guess he paid the price on that day, at least. All right, let's get back to those results from Warner Brothers Discovery. The company coming in with a subscribers beat, but little else that did exceed analyst estimates. The loss per share was wider than anticipated. The revenue came in lighter than anticipated. The advertising revenue also missed the average consensus, as did free cash flow. On top of that, it took a big charge, $9.1 billion to be exact, 11.2 if you add in another charge as well. So let's bring in now Ken Leon. He is research director at CFRA Research. Ken has a hold rating on the stock. Ken, was there anything in this earnings report that looked encouraging?
So what was really surprising was the over $11 billion write-off non-cash items. There'll be more explanation on that. but that does impact the balance sheet. And yeah, we have a hold. We had an $8.50 target. The consensus was a little over 11. And, you know, studios really didn't have a blockbuster movie. And then when we look at the linear networks, which were expected to decline, they did across all items. And then subscribers, you know, the quality is questionable because growth came from international, where the average revenue per user is about 1/3 of what it is domestic, which was flat. So you got subscriber growth. That was the positive news, but it's in the wrong place, paying you $3.85 a month per sub versus domestic flat at $12.10 per average monthly rate. So this is a very confident management. They just started the call. I'm looking forward to hearing what they have to say. But again, this is confirmation that it's very difficult to grow profitably as this industry shifts to digital. And certainly the dominant players are really taking market share, whether it's Alphabet, YouTube, TikTok, Amazon, and it's hard to compete.
And one thing that Warner Brothers wanted to compete on was, of course, its media sports offerings, that content, but it lost out on the media sports rights to Amazon during the negotiation period. We know that Warner Brothers is now suing the NBA, saying it had a contractual right to match the rival offer to carry the games. Short of actually winning the suit, which may be a long shot here, and getting the rights, what is the next best outcome? Some kind of financial settlement that, you know, at least defrays some of the cost that it's now taking on its balance sheet?
Yeah, and there was a response, of course, here. You know, so I think it just kind of, this company really can't compete to the companies I've mentioned. So when you look at large sports rights, they're basically playing into second tier. You know, they just couldn't do it with the NBA. They have selective different types of leagues or sports, but it's not premier. And they are part of a triple bundle here with other players, but it's defensive at this point, and they have to shore up their cash flow and balance sheet. So I don't think this is a big surprise. The litigation isn't going to go that far, and they need to focus on executing on the businesses they have.
Well, let's talk about those businesses, Ken, because that is kind of the bigger story here. And a lot of people are speculating as to whether there would be a breakup in play. But I am curious as to how that would even work, because I thought kind of these different units to a certain extent kind of fed off each other, at least when it comes to content.
It is, but you know, having the right content may have shifted from when this company acquired AT&T Warner. And mostly it's because we're seeing the stiff premium paid for live entertainment, sports, and general entertainment has kind of dovetailed where now we've moved away that you just can't support that because the subscribers aren't there. And then if you're financially looking at all this, you begin to be pragmatic and you reduce programming and production costs, which all these players are doing. So it's a tough game, really, for them to win. And restructuring from here, they don't have any of the drama that we have with Paramount. But again, they, as well as Disney, which didn't do much better today, these businesses have a tough fray against winners like Netflix.
I am curious, though, too. I mean, because when you look at least the breadth of content, I mean, Max, HBO Max, and that whole Warner Brothers Discovery ecosystem, at least just based on my own usage, seems to be kind of miles ahead of some of its competitors. I don't know how it compares specifically to Netflix, but certainly way more than Disney, Paramount, and even Amazon Prime here. And I'm wondering why they haven't been able to leverage that breadth of content in a much better way. Is there anything they can do differently?
Well, I think what's true here for Warner Brothers Discovery, but even Disney, is, you know, they were years behind Netflix in building an intelligent, algorithmic platform that is able to capture user behavior and personalization, no less spread this on a global basis by country to the cultures and likes that they have, and then try to cross-market that into other country markets. I'm talking about Netflix. I'm also talking about Spotify. They're doing that in music streaming. So it takes large capital investments. It also takes really time to put that into place where you have a chance to win.
Yeah, I think that's what it comes down to. Like you said, it takes time, and now it's all about the execution. So, Ken, really appreciate your joining us here. Ken Leon, Research Director at CFRA Research with a hold rating on Warner Brothers Discovery. Just moving over to the broad market for a moment here. I don't think that it's a great sign, Romain, that the equity indexes closed at session lows. It was a steady decline, especially after 1 p.m. when the Treasury auction did not go over all too well. And I'm not saying that one had a direct effect on the other, but sentiment is already so fragile that it didn't help.
Yeah, it certainly didn't help, and it gives you the sense here that a lot of folks are on the sidelines, at least futures here in the after-hours session, only down about 1/10 or so of a percent here, but nevertheless, not the rebound, the extension of that turnaround Tuesday that I think everyone thought we were going to have on this Wednesday.
Yeah, everyone's focused on jobless claims tomorrow and then CPI next week. This is The Close on Bloomberg.
All right, we're about 1 year removed from that big actors and directors strike in Hollywood last year, but now voice actors and performers across the country are now pressing the pause button on the gaming industry. Members of SAG-AFTRA are on strike against video game producers, and artificial intelligence is at the focal point of negotiations. Joining us for right now is the man who helps lead those negotiations. Duncan Crabtree-Ireland is the National Executive Director and Chief Negotiator for SAG-AFTRA. Great to have you back on the program, Duncan. Give us a sense as to exactly what this is about. I remember last year when we talked to you about the actors, and there was a lot of concern about AI and how it was being used in Hollywood. I know you got some of those provisions dealt with in that contract. How is that going to differ, or maybe how is it going to be the same with the voice actors and performers in video games?
Thanks so much, Hermine. Thanks for having me on. It is really the same fundamental issue with a different set of companies. And just to be really clear, it's not only about voice actors, but it's also about on-camera actors, movement performers, stunt performers, and performance capture actors who work for these video game companies also. So really, we're fighting the same battle. We're trying to ensure that there are rights of fully informed consent, that there's fair compensation for the use of AI. And unfortunately, even though we've been able to make that deal with the studios, the streamers, the major record labels covering everything, including even TV animation, the video game companies have just been recalcitrant and refusing to acknowledge those basic principles of fairness and equity for all of the performers who work for them. So that's why we're on strike again in this sort of like sequel, Hot Labor Summer sequel, part 2.
All right, I'm going to ask you a somewhat loaded question, Duncan, but it has to be asked here. I can understand the leverage that actors and directors and basically content creators would have had when dealing with traditional films and TV shows. I would think, though, that given what you're talking about with AI and the use in video games, that it would be the video game companies themselves that might have a little bit more upper hand on them. I guess what I'm asking is, do they need humans?
It's a great question. I think some of the companies are maybe having those same thoughts themselves, but the reality is that the biggest video game companies in the world rely heavily on our members to create the characters that actually connect with gamers. I myself am a gamer. I have a number of games that I really love. And if those games didn't have the voices, the faces, the stunts, the movement, they wouldn't be the same. So anyone who's a real gamer knows that these companies absolutely need our talent. And the fact is that it's going to have a huge impact on the success of those game franchises if they don't have SAG-AFTRA members available to them to make them.
Well, speaking of game franchises, of course, everyone's awaiting Grand Theft Auto 6. Has the strike stopped production of all video game development or production?
Well, for technical reasons, Scarlett, no, it hasn't completely stopped those productions. And it is true that the production process is a bit different for games. It's typically a longer process. The actors' participation in it happens at different points in time. But eventually, that is what will happen. And I think that you're likely to see that impact hit live service games even faster than the rest of the games. And as we know, those are some of the biggest, most successful moneymakers in the industry. So anybody who thinks this can't or won't have a real impact, I think, is very much mistaken.
What is the single biggest lesson that you and the union have learned from the negotiations last year to resolve the strikes against the movie studios and the streamers that are transferable to this round of talks?
Well, I think one of the biggest lessons really is how important it is to connect with the public, to connect with the community, because these companies respond not only to the economic pressure on the sort of supply side of us taking away the talent that they rely on, but they also respond to the pressure on the demand side in terms of their customers, the clients, the gamers, who will say, hey, we care about the artists who help create the games we love, and we're not going to feed the machine if you don't take care of them correctly. So I think we are very focused in this strike on making sure that the entire gaming community understands why we're on strike.
Yeah.
And so far, judging by Comic-Con, we were just there a week and a half ago, and the response from the gaming community was incredibly supportive and strong.
Just one quick final question, Duncan, and this is really on the issue of whether we need sort of more, I guess, government type of guardrails. I mean, because obviously you're doing this for your own industry, but we're hearing from other industries also having to negotiate things, obviously not quite the same as Hollywood. Do you want more of a government role in this?
Absolutely. In fact, there's a new bill that was just introduced in the Senate this past week called the No Fakes Act. And it's crucially important because collective bargaining can only cover so much. We can only address things that affect companies that are signed up to our contracts. But all of us, you, me, everyone in this country needs protection from abusive use of AI. And this No Fakes Act that's in the Senate is a huge step forward in making sure we all can control the use of our face, our voice, and our body.
All right, great stuff. Duncan Crabtree-Ireland of SAG-AFTRA, thank you so much, and good luck to you in your negotiations. Time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Tim Walz, the Minnesota governor and Kamala Harris's new running mate. His financial disclosures show he is likely the poorest of the four people on this year's major party presidential tickets. He's got a disclosed net worth, Romaine, of less than $1 million, does not own any stocks or real estate, but does have a pension, a life insurance policy, and a college savings plan.
Okay. Well, for some people that might be an asset. I don't know. Interesting to see as the scrutiny of Tim Walz continues. Scrutiny also of Claudia Sahm, of course, an economist who's probably most famous for the so-called Sahm rule, which basically predicts recessions based on where the labor market is going. And that rule last week basically triggered that recession signal. But she wrote a column today saying, well, slow your roll. She's like, it's a great rule, but we're not in a recession, though she does say that she does think there's some economic weakness ahead here, and she still thinks her rule and the methodology behind it is valid. But for us being in a recession at the moment, she's saying not quite.
Yeah, and so the net effect of that is she's calling on the Fed to cut rates to prevent that recession from coming on. Third on the docket is former baseball player Billy Beane. Now, to be clear, this is not the Billy Beane of the Oakland A's that Brad Pitt depicted in Moneyball. This Billy Beane that I'm talking about played in the MLB for the Tigers, Dodgers, and Padres. After he left baseball, he became the second player to come out as gay. He was 60 years old. What's interesting here is he came out in 1999, and 15 years later, Romaine, MLB named him its first ambassador for inclusion. It took 16 years.
It took 16 years, and I mean, obviously a milestone for him, but you also get to this idea. There's been a lot of talk about some of the Olympians who are out and proud in a way that you didn't get when we were younger.
Absolutely.
Most of these people came out after they were out of the locker room.
Yeah.
But now you're seeing a lot more folks comfortable with coming out in the here and now while they're actually playing.
Very well said.
Yeah. We'll be back in a moment. This is The Close on Bloomberg.
A 50-point cut probably in September, and then 2 quarter-point cuts. The Fed may be wanting to weight the front end of that a little bit more just in case they're a little bit behind.
And that was Paul Christopher over at Wells Fargo Investment Institute on our program yesterday. He kind of surprised me when he said that we were going to get 100 basis points of rate cuts this year. But Bloomberg Economics saying, yeah, we're going to get a full percentage point this year, 50, 25, 25. Stuart Paul joining us right now to talk a little bit more about the thesis behind it. And we should point out, I mean, the market basically agrees with you. If you look at the work function on the Bloomberg, they're basically pricing in a full percentage point as well.
That's right. So we think that basically everybody's catching up to where we've been, that the labor market and the underlying fundamentals of the labor market have been signaling a material cooling of the labor market material cooling of wage pressures, and we're going to start seeing that in inflation. So we're expecting the Fed to kick things off with a little bit of a catch-up cut, starting with 50 basis points in September, let the dollar circulate a little bit, followed by 25 basis points in each of November and December.
So it sounds like a 50 basis point cut is an admission that they were late to the party. When you talk about jobless claims, there's a lot of focus on it, high frequency data point here. How much of a focus will it be in terms of giving us a read on how the Fed proceeds? Because we're now looking at a consensus of 240,000 jobless claims.
So the consensus is expecting a little bit of a step down in initial jobless claims. Part of that is an expectation that workers in Texas who have been affected by Hurricane Beryl are going to be showing up back to work again. On an unadjusted basis, seasonal factors are expecting, the seasonal factors used in the background at the Census Bureau and the Department of Labor are expecting basically no change. We think that the cooling underlying pressures in the labor force, in the labor market more broadly, are actually going to lead to a modest uptick in unemployment insurance claims. And we think that if we go above that 250,000 initial claims mark, that could be a bit of a wake-up call again to the Fed to kick things off with a 50 basis point cut in September.
What do you think about the communication, though, that we got out of this last meeting? Because on one hand, Powell seemed to be like making it clear that they were at least ready to consider rate cuts, but he didn't come out and definitively say, look, this is happening in September. Does it matter that he didn't say that? Will it be a shock if we get the 50 in September 18th, or does it not matter?
I don't think so. I don't think that past communications are going to matter much going forward. There's still a lot of communications to be had, and we're going to have a lot of Fed speakers coming up. We also have Jackson Hole coming up in about 2.5 weeks. So there is still plenty of time to get the point across.
Did you get an invite this year?
I did not. Not this year.
Okay, maybe next year. Stuart.
Maybe next year.
All right, Stuart Paul over at Bloomberg Economics. Not bold call, really. Pretty much in consensus here, as he said. Maybe the market's finally catching up with Bloomberg here. As we push ahead to some of the potential market-moving events over the next 24 hours, we start in the morning, Scarlett, with more earnings.
Yeah, Eli Lilly and Restaurant Brands. And of course, Restaurant Brands gets my attention because of the way that the consumer has really been pulling back on spending. Yes, they're spending on experiences, but not at the same rate as they were a year ago.
Yeah, absolutely. And it's like, and we've seen this from so many of these companies, these food companies that have reported here, not in the same store traffic, and the people who are coming in, they're eating, but they're eating less or drinking less for that matter. After the market, we get some more restaurant companies, including Sweetgreen, and also a lot going on in the media space, Lionsgate, News Corp, and Paramount.
Yeah, that'll be interesting, especially for Paramount, given that it's it's already negotiated a takeover for itself, but the numbers will really drive home this idea that streaming companies are under a lot of pressure.
And I wonder, given what we saw out of Warner Brothers today here, which they weren't awful. I mean, if you ignore the big write-off, but that was for past issues that they had. But if you look in the here and now, the streaming business wasn't awful.
Well, we'll see. We'll see how it goes. I mean, they did pick up subscribers, but it was international, not in the U.S.
Yeah, we hate international subscribers. All right, Fed Speak. You love Fed Speak, don't you?
Well, Fed Speak got a lot more interesting, or it's going to get a lot more interesting now that we have this jobs report and the market meltdown to contend with, right? I mean, everyone's looking at this through a new lens.
Yeah, absolutely. Initial jobless claims coming out in the morning. And of course, if you push ahead to next week, we get some key inflation data that could move the market as well. Scarlett and I will be back tomorrow for all your market coverage here on The Close, but stick around. Politics up next with Balance of Power. This is Bloomberg.